Can you talk a little bit about the kind of dynamic between the tech-focused, kind of cutting-edge panel manufacturers versus what you're seeing from some of the more commodity-focused manufacturers like Jinko Solar, and kind of what investors should think about when deciding where they should allocate their cash between those two kind of broad categories of panel makers?
Yeah, I think that, so there's really three legs to the stool, so to speak. Right? You have the companies that are focusing more on the commodity. They're really focusing on driving down their cost per watt as much as they can. And essentially so you have two panels, they're the same size physically. Their power production qualities can be very, very different, right? So let's say, for example, you have a SunPower panel. SunPower makes some of the most efficient panels that generate per square inch of space, that generate the most electricity in terms of output on the backside. Now, then you take a Canadian solar panel or a Jinko solar panel, they may only be operating at 16 or 17% efficiency. So you think about the difference between 16% efficiency and 21%. So that 21% of panel actually generates about 20 to 24% more electricity. So that same size, you're getting a quarter more power from the same size, right? So when you're actually pricing them out, you look at the cost per watt, which normalizes based on actually how much power you're getting from it, right? So companies like First Solar, which makes the thin film panels, which really work really well in temperature variations like high heat or colder areas, they tend to produce a more consistent amount of power. And then SunPower, which is just super high efficiency. And then on the other hand, you have the commodity panel manufacturers. The idea, what you have to look at with these companies is look at their cost per watt. How much does it cost them to manufacture a panel on a per wattage basis? So when you're looking at them, that's, as an investor, that's something you really want to understand about their business. The next part of it is you want to think about balance sheet management, because the demand, this is an excellent year, demand can shift substantially, from one year to the next. You have to look at how financially well built is the company in terms of being able to ride that out. I think a good way to look at it on the best case scenario is definitely First Solar. This is a company that has something like $2 billion in cash, a little over $2 billion in cash on its balance sheet right now. We're heading into 2019, which is not expected to be a particularly good year for the solar industry. It's going to be a little more stable than 2018, but it's not going to be a particularly booming year. First Solar is going to invest somewhere between $650 million and $750 million in adding to its manufacturing capacity, to its Series 6 panels, which are its newest, most efficient panels. And it's still going to generate roughly $300 million in positive cash flows over what's going to be a bad year, and it's going to be making substantial investments. Most of its competitors are going to spend 2019 just trying to make it through. You're not going to see them being able to make these big investments because most of these companies don't carry anything like the amounts of cash that First Solar has, and they also tend to carry substantially more debt as a portion of their total net value. So that's the reason for me. SunPower, when it comes to investing in a panel maker, SunPower is one that is always at the top of my list. I think if you look at how much its stock price has fallen this year, I think now is a great time to be looking closely at SunPower.
So SunPower, is that not First Solar would be what you'd be most?
I'm sorry. I was looking at SunPower on my screen. First Solar. Thank you for catching that. Yeah, First Solar is absolutely at the top of my list and generally always stays there. And I think, especially at the value, at the price it's at right now, I think it represents a pretty good value.
Yeah, it sounds like it's very similar to what we talk to our listeners about with oil and natural gas businesses, and that you really need to have a strong balance sheet to be able to ride what goes on in the cycle and be able to make investments, not whenever it works for you, but whenever the market justifies it.
Yeah. I think actually probably the best industry to compare it to in terms of the cyclicality is the steel industry. You think about steel makers, it's an industry that the shifts in demand can be very sudden and can be very large, but these are very capital intensive businesses with high fixed costs. and you can quickly swing from losses to profits in a very short period of time. So I think a company we've talked about before, I think First Solar is kind of like the Nucor of the solar industry. It doesn't pay a dividend; it's a newer company, but I think in terms of that balance sheet, management that does a really good job of allocating capital, I think that's the good comparison for me.